following class after the reading week. So, chapter 16 is focused on the cost allocation. And there in the cost allocation, we have a different line of businesses that includes the joint products, and some line of manufacturing businesses may have some byproducts as well. In those situations, we look at what do we do with the product costs which are jointly spent on the products which are either are byproduct or the products that are being sharing the same cost. How do we allocate those ones? So there are five different learning objectives that we are going to go through. So one, we're going to understand the difference between the different types of products that we sell, the scrap that comes from those products, and the toxic waste. How do we deal with those things? So before we dealing with those things, it's important for you to understand what these are. And then we look at the different methods that we're going to use for joint allocation. Then we're going to analyze those methods as well as what makes sense for the companies to use. um, Understanding the irrelevance of the joint cost when you are using the byproducts within the organization, why they consider to be irrelevant, or consider that to be a sunk cost. Then we look at the implications, the strategies that are used for decision making purposes. Why is it important to allocate those costs? And then at the end, we look at the byproducts as how do we account or those byproducts and the money that you receive from the byproducts. What do we do with that for the reporting purposes and the cost allocation? First, the most important thing is understanding the terminologies that are being used in this chapter. First one is a joint cost. That's an important thing for you to understand is in the organization, there are some costs that you're spending not to produce the final product, but to process a certain item. So in that case, you don't know how much cost is spent for product one and two, because you're simply spending that cost to process a product, and after that money is spent, then you ended up with more than one product. And then the question comes in, how do we allocate that? Okay. So first you need to understand is what is joint cost. So any cost that you spend on manufacturing the product before it comes into their form. So those are considered to be a joint cost. Split of point. So you all know that whenever we have a product that we're developing, so technically in a manufacturing place, there's a circle that is a processing cycle that they has to go through, which includes starting from buying a raw material and then getting up to the finished product. The split off point is when you spend the joint cost, and now after that you have ended up with two or three products, and now you know that from that point, any money that you're going to spend is going to be on a particular product that you're developing at that time. So split point of is where you know that the product is ready, and now you step spending the money to process to that particular item that you are producing. Separatable cost. Separatable cost is any cost that you spend after the split up point. So for example, if I have if I have a milk so it's a dairy, so they have a milk as a raw material. That after milk, they may produce cream, they may produce special cream, which is like buttercream, or they put like vanilla syrup to create certain kind of a butter. So those are the products that are being done after you have produced certain products, and then any money that you spend, especially on those products that you're producing after the milk is processed, those are considered to be a separatable cost. So any money that you spend on the product specific after the split up point is considered to be a separate cost. Then product. What is product? The product is a finished item. After you have spent all that money, then you ended up with your finished product, which is like either two products or three products using a raw material. Those are considered to be your products. Any outputs are sold, obviously, to the outsider, or it's further maybe used within your processing department as well. Categorizing a joint process output is either positive or zero. Sometimes you have the outputs, sale volumes that may ended up you getting a revenue out of it, some products that may come out of that which are kind of a scrap, and then you have a zero sale value to that. So you have to look at it, what kind of products that are coming out of it. So joint products are the output of the production that use two or more products with the high sale volume. So you always have to look at it. The ones that are being a high sale, which are the main products, are considered to be a joint product. The main product is the one product that you are producing. For example, if you are in a manufacturing facility and you know that the main objective is to produce, let's say, cream, that is what the company is doing. And then after you produce a cream, there may be a skim milk, there may be something else that came out of it, but that's not their main product, but they may have the opportunity to sell that product. So those items will consider to be not high sale items, so but there still be some value to it. But then we need to identify what the main product is. So the it is important for you to understand those things because that helps the decision making of how do we allocate those items when it comes to the cost allocation. So byproduct, scrap and toxic waste. So before what we were understanding in the previous slide, joint products is when you have multiple, and your aim is to take a raw material, ended up producing two or three joint products out of the same raw material. But if that is not the case, if you have a company that's producing the main product, so you put a raw material, you produce the main product, and that is what you're going to sell. But then when you are producing that main product, there may be certain items that come out in a finished line, they may be one of these things. There may be a byproduct out of it. Right? So when you're producing a cream, there may be a skim milk or something else that may comes out from that production. That's considered to be a byproduct. Okay. So byproduct, maybe you don't going to get much value out of it, but still some value may come in. So that's considered to be a byproduct. So it's not a high sale volume, but still a low sale volume from there. Then we have a scrap. Okay, so now there may be some manufacturing plant that is producing certain items, and then from those certain items, when you develop the finished product, there may be some scrap that comes out of that as well. Those scraps they need to either throw it out or they may sell it to another company for a scrap value, and then that scrap may be used by another production line in another making another product. So there may be an opportunity for you to sell the scrap for a certain amount, and some companies may just sell it for zero value because there may be some cost they have to have they may have to spend to uh, to, dis- to dispose of that product. So in that case, they may sell it for a zero sale. But from my experience, usually when the scraps exist, there are always a buyers who are ready to buy. But again, that depends from industry to industry. So so in this case, you always have to remember that if there's a scrap, if there's a value for that or not. If there is a value, then we need to look into it. How do we allocate the value in regards to your costing purposes? Last but not the least, the toxic waste. That's an important piece because there are certain industries that produces certain products, and then it ended up producing some toxic waste as well. And now, when it comes to those industries, they may have a budget or they may have a cost assigned as how they get rid of that toxic waste, and then that cost, the negative cost of toxic waste, need to be considered as part of your planning for costing purposes. So any cost that you spend on disposing the toxic or the uh, recovering back to the environment need to be considered and added as a joint cost in your analysis. And then obviously when you do that, you need to look at those methods that we're going to talk about and allocate those costs either to joint products or to the main product that you are producing from that environment. So here is your diagram that dictate how these kind of products are created. So all the terminology that we have looked at in the previous four slides. So here they talk about in a diagram. So let's say that I'm buying the raw material, that's your input right here, and then the money that you spend on develop or processing this product up to this point before the split off is considered to be a joint cost, right? So the example that I'm giving you, that we buy a raw milk and then process them, any money that we spend on processing that is considered to be a joint cost. At this point, you have a split off. So in the split off, you have joint products. That means we're producing two different products in this example. So there is joint product one, joint product two, and both have their high sale volume because that's their products that they're selling, and that's where the company's business is. Okay, so that's the case. So now these are your joint products, and any money that you spend from here to getting that product A ready to you to sell, these are considered to be a separate cost. Any money spent on during this period is considered to be a separate cost. So that's your example when you're doing a joint product. Now this is your example when you are producing a main product. So there's only one product that you're aiming to get. So you start with the raw material, you keep processing, and then the entire processing cost is going to go to this product because that's the main product that they're selling. Out of that, there may be a byproduct that comes out. That byproduct is not your main product, but it still has some sale value because you still sell it to the market. So the example that I was giving you with the milk, that your company is famous to produce a certain type of cream. So what you do is your main line of business is to produce that cream, and then you produce it. That's your high volume, and then by producing a cream, you may have some uh, skim milk that came out of it, and that's considered to be a byproduct. Okay, so in that case, that's a low volume or low amount of sales that you may have, but still going to be considered as your byproduct in that case. Then if there's any scrap that comes out, that's going to be a minimum value or a zero value that's need to be considered as well. Um, so in this case here, there's no extra processing cost because they're simply a byproduct, scrap or a toxic waste that comes out. So in the toxic waste is at the bottom because to get rid of that, you may have to spend the extra cost. So that extra cost need to be added into your product cost, which was the main product that you're producing. Okay. So example, actually, this diagram actually elaborates how these costs need to be considered. So here are some industries that have these joint costs as applicable. There it's not limited to this. There may be some other businesses as well, but these are like the main ones that you may see in real life, like cocoa beans. They produce cocoa beans, and there may be different products that they may come out when they're producing the beans. Meat, lambs, hogs, lumber as like your um, uh, the wood that they buy, and that they may ended up producing certain furniture, certain equipments, and then there may be a byproducts out of that as well. They may use the lumber to produce different things. So then we have the extractive industry, which is mostly like focused on the coal, copper ore, petroleum, salt, and these are the industries that may have different products that being produced. Uh, so here is the type of products that they will produce. Obviously, petroleum is a huge market, and then obviously this may have they may have some environment factors as well. They need to be considered when they are allocating, or they have a toxic waste that comes out of it. Chemical industries, semiconductor industries as well. And obviously, if we look at the manufacturing industry, there may be some manufacturing industry that exists as well that may ended up with the joint costs and joint products and some byproducts as well. So uh, not so important, but again, it's important for you to know when these what kind of industries may come in when it comes to joint costs. So it's a good question as well, where I give you an example, then so tell me which one is considered a joint cost industry. Uh, what is the reason for the allocation of joint cost? So the main reason is the cost allocation, because the user or the management likes to see the real profitability of the product. So when it comes to the inventory valuation or the cost of goods sold, you may want to understand what is the profitability of each business line. So for that, it's important for you to make sure that the cost is being allocated to the different products, or the cost is being allocated in a way that it is looking at all the different factors such as byproducts as well. So the cost allocation is important for the external financial reporting because the users wanting to see the profitability of each product that exists within the company. For tax reporting purposes, the financial reporting purposes, because there may be different inventory that exists, and then having the right amount of cost being allocated will make sure that the inventory is being calculated right, because it will directly impact your cost of goods sold as well. And tax reporting, the pricing plays an important role because it may inflate your profit or may devaluate the inventories as well. So for tax purposes, they put some laws to make sure the inventory is not overvalued or undervalued for tax purposes as well. So those are important factors. Internal financial reporting when it comes to the management like to make informed decisions. So in that case, management need to know if what is the actual product cost by considering the various factors that we talked about in the previous slide with that diagram. Cost reimbursement. Sometimes what happened is when they have different departments that manages different costs. So 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 those costs have to be reimbursed to the other departments because those are not the direct costs that's associated with those departments. So there's a reimbursement that happens. Sometimes it's a different department, so therefore the costs need to be allocated to make sure that it's reimbursed. Sometimes what happened is these products may be grouped together and it's being reported in a separate entity. So in that case, if it's a joint cost and that joint cost need to be allocated and reimbursed from one department to another. So it is important for that reason as well. Customer profitability analysis. So sometime in the long run, you may wanted to see that because there may be a lot of competition. So in that case, you wanted to understand the profitability that comes from a different customer. And then some customers may be very sensitive, some may not be. So when you have different products coming in, you wanted to make sure that what is your gross margin on each of the line, what is the cost involved in producing those products. So you can understand the profitability comes from each product. And then also the profit that comes from each customer as well. Insurance settlement. Sometime if something happens in a business, there's a damage, there's a fire, and then when it comes to the reimbursement by the insurance, they wanted to know the costing to make sure that they understand the cost of each product, which are the main or the joint products, or even scrap as well. Rate regulations. That's also important. So I think there is another chapter we're going to talk about the transfer pricing. So sometimes what happens is when the products are being produced, they may be shipped from one country to another. So there may be a regulations when it comes to charging a price as well. So in that case, you may want to look at the regulations that exist, and then the costs that are being added are being done correctly based on the regulation that existed between the country, or it could be between the provinces as well. Litigations, there are certain litigations for certain industries that exist that may require the companies to consider certain costs as well. So the good example is your waste toxic. So there's certain cases that exist. There is ruling that may have been passed to do certain work or certain environment stuff to get rid of the waste. So you need to consider those ones as well when you are doing the joint allocation. So here are the different methods that exist for the joint allocation. We're going to get into the detail in the next few slides, but I'll just briefly mention what they are. So there are three methods that are based on the market base. Is considered to be sales split off. So when we do a split of joint cost, we look at the dollar value of the sales coming in and we allocate a greater proportionate amount and allocate the joint cost. Then we have a net realizable value. So obviously we look at the net value that comes out from each of those sales, and then considering the cost comes out of it. What is the net realizable percentage as a margin? and then allocate the joint cost based on that. The gross margin, the same concept, but here we're looking at the gross margin versus the net. And then there's another one which I feel is the most common and the most easiest method to use the physical measurements. So this is easy to use, but again, only applicable if you can measure the physical quantity of the products that comes out from the raw material from the production line. So if that is the case, you use that as your tangible base to create the proportion between the two products that or three products that it produces from the processing of the raw material. So here's an example of what the joint cost that you have a raw milk that you purchase, which is 4,400 hectoliters, and the processing cost was $345,000. Out of that, they will produce 1,000 of cream and 2,000 hectoliters of liquid skim milk, and this becomes a split up point. Then there's another example where you have a product that you're processing. Out of that, you ended up with a three different product, and then you have a separate cost of these products, and then you ended up producing these three items. So this is when you have a product cost and a separate cost as well. In the previous slide where we're looking at the example, that simply focused on the two products, and there's only a joint cost, no separate cost. So obviously we will use these two examples to illustrate different things that we're going to talk about in this chapter. So here's the physical measurement method. So in this method, we are going to be basing it on a weightage or the volume that comes out from that product. So we're going to use the example that we had in the milk situation. So we have used 4,400 raw material. But what's important for us is the cost of producing up to the split up point. So the cost that were given to us was $345,000. That was the total cost. So what we are concerned about is at the split point or the product that it comes out is how much of product, because we're looking at the physical measurement. And this is method I say is easy to use, but it's only easy to use if you can measure the quantity that comes out from the production. So at the split up point, we know that we're gonna get 1,000 hectoliter of cream and 3,000 hectoliter of liquid skim milk. So in total, we're gonna get 4,000 hectoliter out of the production line. So now what we did, we created the weightage between both these products. So 1,000 divided by the total, which is 25%, and there's 3,000 divided by the 4,000 is 0.75, which is 75%. So now when it comes to joint cost, we know that the cost was 345,000. We allocate 25% of that to the cream, and 75% of that we will allocate to liquid skim milk. And after we do that, then if we wanted to calculate the cost per hectoliter for these products, we simply take the cost that we allocated divided by 1,000 here, it becomes 86.25, and then here divided by 3,000 is 86.25. Technically, you will come out to the same cost per hectoliter because what we did, we kind of like allocated with the same proportions. Even if we do 345 divided by 4,000, you're going to get 86.25. But this is the right way of putting it together so that way you know how much is supposed to be allocated. Then we have a second method which is focused on the sale volume. So in this one, we are going to look at the outcome, which is the production, the finished product that came out. But then we're not going to look at only quantity, we look at the sales volume. Because obviously the cream may be selling at a higher price versus the liquid skim milk. So what you need to do is we need to look at what is the dollar value that comes out of it. So now what we're gonna do is the only change that we're gonna have is instead of using the quantity, we're gonna use the dollar amount. So for the dollar amount, we need to know what is the sale price for these products that came out from the raw material that we used. So in this case, we have 1,000 hectoliter of cream selling at $155 per liter per hectoliter. That gives you a total sale of 155,000. Then we have a liquid skim, which are selling at 75 hectoliter times 3,000 liter, that's 225,000. So total sale that we're going to get is 380,000. So now we're going to calculate the ratio as what is the percentage of cream from the sales and the liquid skim. So remember in the previous slide was 25/75. In this case, this becomes 40.78, which is looking at the total sale of cream divided by the total, and the sale of the liquid skim divided by the total of 380. Once we get this percentage, what we're going to do is we're going to take that cost, multiply by that percentage, and that was so 40.789 times 345, 59.221 times 345, that's your cost. Then we look at the joint product cost per unit. Obviously, we're going to get a different amount because now we're not simply proportionate based on the quantity, but based on the dollar amount. So if we just take that amount divided by the number of units produced, which is 1,000 hectoliter. So that is shows up to be 140.72 per hectoliter. This one, because it's 204 divided by 3,000, that comes out to 68.093. Now you can directly compare this with what they're selling it for. So now see here is 140.72 is a joint product cost being allocated, and the amount they are selling it for is 150 per hectoliter. So see with this, it gives you a little bit of an information about setting up the sale price as well. Okay, so is more accurate because you're simply dealing with the sales. But whereas in the previous example, it doesn't matter what this product is, we will simply base it on the proportionate of the liter that's being produced. So I feel that this method is easy to use, but using a sale volume split, it makes more sense because the price will has a different type with it is a different price tag for both the products. And they are two different products, so I think it makes sense to look at the product sales versus looking at the volume of the quantity that it produces. So now you can see that the cost is 140, 72, and 68. So that way, when the management is making a decision of setting of the price, it gives that information that they have to sell it for $140 more to make gross margin or even to contribute to the business as a high to, to contribute to have a higher contribution margin. Then we have a net realizable value. So it's just a little bit of a process that you have to go through. So I'm going to walk you guys through the process in both the net realizable value and the gross margin. And again, you're allowed to use the cheat sheet to write down the process. But I think if you understand, write down the formulas. But for this example, it's the walkthrough process. So first thing that you do is when you use a net rate as a value, you need to look at the sales amount for both the products. So we came here. So this is another example. They say they set up, and this net rate as a value is only used when you have a separate cost. Okay. In the previous example, we say, okay, well, they use milk, raw milk, and produce the cream and the skim milk. But now what they did, saying, okay, well, they're gonna use the cream to produce the buttercream and the condensed milk. So they're gonna use that to do these two items. So now in that case, we're gonna use the net realizable value method or the gross margin method. So these are the two methods that's only used if the company has a separate cost as well. So after joint cost, they're gonna still process the product and then have that product produce these two products here, which they're gonna sell it to the market. So in that case, you always start with the sales value. So saying that the buttercream they're gonna produce, they're gonna sell 800 hectoliter. They're gonna sell it for 420. So we get a price here, and then we get a price here for the condensed milk. So that is your total sales. Then from that, you take out the separate cost, saying these are the individual sale price. From there, I'm going to take out the separate cost, which is after the joint cost, as how much money we spend from that point, split of points to produce the buttercream and the condensed milk. And they'll give you that amount 135 and 270. then that is your net realizable value from these products. Then what you do is you calculate the weightage using these amounts. Say, okay, well, these are the net realizable value after the splitter point or at the time of the splitter point, and then we calculate this is 37.15% or 0.3715, and this is 62.84%, which is 0.628466. Then what you do is you use these proportion and allocate your joint cost. Now we can say, okay, well, we have this 345,000 as a joint cost. How do we allocate? We take that amount, multiply by these ratios, and that gives me the joint cost that I allocated. And then obviously now this is joint cost, this is separate, and then we will calculate the gross margin if you need to calculate the gross margin. So now they're saying is, do you want to calculate the cost per hectoliter for the buttercream and the condensed milk? You can do that because now we know that this was the cost that directly ties up this, and this is the cost we allocated. We add both of them divided by the 800 hectoliters. So we take 188, 128, 179 plus 135 divided by 800 hectoliter, and that gives me 328.97. And then we do the same thing here. We take 270 plus 216 divided by 2000 hectoliter, and that gives me 243. And then you compare what you're charging to your customer, saying, okay, well, this is the cost, this is what I'm charging, 305. This is the cost, 328, and what I'm charging is 420. So you see that there's a margin there. Okay. So this is also a very popular method to be used, but it does require some calculation for the allocation purposes. Then we have another method which is gross margin. So this further takes it down to the gross margin level versus just stopping at a split level. So there is an extra step now. Previous one was two-step process. This is going to become a three-step process. So in this example, what we're going to do is we're going to look at the sales volume, which is the 946, the total sale that we came that came from all the joint products that we are selling. Take out the total cost, which includes the joint cost and the separate cost, and that gives me a gross margin of 196. So the beauty of this is that the gross margin is going to be something that's going to be not on an individual product line, but from the overall company gross margin. So it says that the company's gross margin is 20.79. So once we calculate the gross margin, then move to the step number two. And in step two, what we do is we look at the sales for both the products, and then from there, what we do is we take the cost, okay, which is a 336. So that's you see that 197 was your gross margin. So what we do is so this is kind of doing a backward calculation. So we take the sales. Out of that, we know that the gross margin was 196 for the company. We take the gross margin of 196, take it out from the sale. Okay. So from 336, we say, okay, well, the gross margin was 20.79. So what we do is we take 20.719 times 336. We take that margin out. And once we take that margin out, that shows up that this is your total production cost for buttercream, and this is the total production cost for the condensed milk. Once we know that cost, you can separate what was the deductible separate cost because we know how much was spent on each of these lines. So from 266, which is the total cost we estimated, and then we take out the separate cost that was spent for the department. And then once we take that out, that gives me an amount which is the joint cost that we are going to be using or we allocated to the product. It's not a practical way of allocating, but some companies prefer to do that because they say, okay, well, we want to make sure we want to make fair with all the different products that seem produced within the same umbrella or within the same industry or same manufacturing plant. Then what they do is they will take that approach. I will always say this is a backward approach of going into the sale, taking the margin out and estimating what the production cost is going to be, and then take out the separate cost, and then whatever is left is going to be the allocation between allocation of your joint cost between all the product line. Okay, so you see that we calculate the gross margin, which is uh, after we check out, that gives me that this was your total cost, right? So which was something that we calculated before. And now from here, we take out the separate cost, and then we know how much is for each department. Then we have 345, and then we just say, okay, well, whatever is the remaining, that's how the allocation is. And then you can calculate the percentage here. There's no point because this is your last step, and this is how you will allocate the 345. So again, these are great questions. So I think these examples that will definitely help you to do some of the homework questions as well. And actually from this chapter, I feel these are like, these four different methods we talk about. It could make up good multiple choice question for each situation, but gives me an opportunity to maybe like pick up either the net or cross method as one of your small question as well in your midterm too. Uh, Which method to use? Again, that depends from the company or from industry to industry as well. So as I mentioned, the volume one is most easy to use, but doesn't provide very valuable information to the management for decision making purposes. So to me, I think sales volume makes more sense. Still simple to use, and it could be done. It can be used in a very systematic manner, and then we're not estimating anything. We're simply basing everything on a sales volume side. It's still simple to use, and then and still produce the valuable information. But if you're using the other product as the NRV or the gross revenue method, they are still applicable and still acceptable within the industry and also for reporting purposes. But I think it's a management preference of using those methods. The next part we have here is uh, method selection. We talked about this. Seller process for the diseases. So technically, the cost that we allocated, sometimes what happened is the product is being used within the company after the joint products are used. Instead of selling them, what they do is they will just transfer to the other other business. So in that case, the joint cost become a sunk cost. It doesn't matter at that time because you know that the final product that you're producing is not those joint products. So in that case, that joint cost that you have become a sunk cost because you spend it to produce that, and now that product is going to be used further into processing, and it will be observed within that production line. So in that case, that for decision making purposes, the joint cost is going to be a sunk cost and will be irrelevant for decision making purposes. So in this slide, what we're going to do is we're going to focus on sell or process further income statement example. So it's an example of how does the contribution margin look like, how this information is processed in an income statement. First, we do all those calculations for internal reporting purposes. Once we do that, then what we do is we take into consideration the product cost. So here are the products that we produced. So this is what the sale price was. And then there are certain products that were produced, but they were not sold. But what we have to do is we need to allocate those costs to that as I mean the price here as well, because this is going to be staying within the company. So it will gets added, and this becomes your total sale volume of the production. And then after that, you take out the separate cost, and that gives you contribution margin to the joint cost. After that, we just consider the joint cost and put that number here, and that gives you your gross margin. So in that case, we don't need to worry too much about the cost allocation because this becomes more of a sunk cost because they gave you that information, and then we just need to elaborate that at the end when it comes to the joint cost and then calculate the gross margin in this case. So this is where we look at in regards to uh, the products being used within the organization. So in that case, this become a sunk cost. So what we do is we just simply do a contribution margin calculation before the joint cost, and then after that we simply take away the joint cost. Then we don't have to worry about the allocation method because we simply do the reporting based on the total value versus allocating to the cost. So there is always some challenges when we use these methods. So the one thing is always the conflict between the management, because these products are being run or being produced at a different level, may have a different management teams. So if you ended up with over allocated the cost to one department or one product than the other, so there's always a conflict that may comes in, because those costs may not be controllable by the management or the team that's managing the particular product. So it creates a conflict within the management as well. So in that case, they may consider looking at performance evaluation method, where when the managers or those product managers are being evaluated, the teams are being evaluated, they may have to do a separate calculation to see the efficiency of those departments. So that's what the management may ended up creating, taking care of that conflict. Market-based joint cost allocation. Sometime when the management of the plant is using, or the production facility is using one method, but the industry is using a different method, so it can create a conflict in calculating the cost and and setting up the sale price. If the industry is using a different method, then it could create an issue as well, because then you may, for compatible purposes, may set up the price differently, but then you may ended up creating a loss for one product versus the other. Allocating joint cost could, using a physical method, create a negative outcome as well. So that's why I don't prefer to use the physical method, because we don't look at the sale price, which is an important role, because some products may have a higher price tag and may use the more of these products cost. But when we do the allocation, it simply look at the volume, not the volume of the product, but not the dollar value of the product being sold. So then the next part we have is, now we are getting away from the joint products and getting into the byproducts. So the byproduct that comes out from the main product, or even from the joint product as well, they may ended up selling or creating some value as well. So if it is a zero value for the scrap or the byproduct, we don't need to worry about, because it simply goes out and we have taken care of the joint cost. The only issue comes in when you have a joint byproduct or a scrap, and there's a money you're going to get out of that. So obviously that will decrease the cost in some way to the company. And how do we encounter that in our cost allocation? So there's two ways: production by product method, and then sales by product method. Production by production by product method, we recognize the product as an inventory cost, and then take it out at the time of the sale, as recorded as at a selling price, or at a selling price less than the normal market. So that's when we're using production by product method. So whenever we're using the sales by product, so we wait till the sales happen until they are sold, and once they are sold, then we'll recognize them as part of the sales, and then obviously it will decrease the gross margin at the end. So we don't decrease it or do an adjustment to the inventory, we simply take it out or add it into the sales. The revenue will go up with that product line. It's easy to use that way as well, but then we ignore the inventory, because there may be some items that still exist that are not sold, and then we don't factor that in. So that's the one disadvantage of using the sales by product method. So here is the last slide that we have that kind of demonstrate the both the methods for byproduct. So in this example, see in the production line, we have a sale of the main product that stays here. And then when we have the byproduct, so here is the value for the byproduct. So deduct byproduct of volume. So there's 700 ton of byproduct that was produced, times it by the quantity cost, which was already calculated the way that one of the method that would have been used by the company. In this case, they gave you that. So we simply take that amount, and we see that we decrease the cost. We look at the total amount that was came out from that production, and we simply take it out from the cost of goods sold, and that shows us the net value. But if you look at the sales method, in that case, we don't care about how much of that byproduct came out. What we care about is, out of that byproduct, how much of that is being sold. So in this case, what we do is we simply take out that 450 tons of byproduct came out. We sold it. So the cost was 86. So you either do it either look at the cost, or we look at the price that it was sold it at, or we take it out of the profit. We don't know the if we are estimating, we can do that. But in this case, they are saying that they are this is the cost and this is what they're gonna sell it for. So they sold it, and they will recognize the sale amount here. If the sale price was different, then we'll use that price that they give it to us, and that will be added into the sale. Indirectly is doing the same thing, but the only difference is that here they take away the amount, but in this case they only take care of that sales. So technically, the remaining we wait till it sells to reflect it in the income statement. Now, the other thing that I was saying about the inventory, you see that here inventory cost, we don't recognize the cost as well. So technically, this is one of the disadvantages is that we ignore the inventory. We simply look at we can look at the byproduct and see what we can sell and only recognize the portion that we sold. So we recognize the portion we sold that shows up here, and then there is no adjustment to the inventory because we already added that into the revenue. And then over here you see that 700, and then out of 700 250 is still remaining, so that shows up as an inventory as well. Okay, see that 250 times 86, because that was the inventory that was on hand, so we recognize that in the inventory. So I think this gives you more informative, and then you still have some inventory that shows up in your balance sheet as well. Okay, so that's where the different reporting comes in, and it could impact the financial statement as well. So the companies will definitely pick one or the other method. And is both the methods acceptable? Yes, both the methods are acceptable for reporting purposes. So the management can decide whichever method they use. They want it to be consistent with their method that's applicable as well. So that is the end of this chapter. So now what I recommend you guys to do is to read this chapter. After you complete reading this chapter, go back to the announcement that I posted and do the assigned homework question. Okay. So when you do the homework question, because this chapter is going to be in your midterm as well, I think for multiple choice question, definitely is a great chapter for me to pick